Good day and welcome to the Asset Events Plus exclusive webinar on the rise, unlocking India's opportunities. Economic reforms over the past decades have transformed the country to become one of the fastest growing economies in the world. India's capital markets are running at top speed. More than 38.2 billion US dollars has been raised on the stock market this year, the highest in Asia, more than double the amount over the same period a year ago. India's bond market is also getting a boost. The country's inclusion in global bond indices is starting to accelerate inflows, with an estimated 20 billion US dollars to 30 billion US dollar entering the market this year. Foreign portfolio investors are rushing in too. They join the similarly enthusiastic local investors who have piled into mutual funds, with investments now exceeding the annual level of each of the past 16 years. Meanwhile, the country's regulators are racing ahead to improve market access, keeping the CCPs, depositories, and custodians very busy. A plan to shorten further the settlement cycle to T+0 is underway. These are exciting times in India in investing and in unlocking the opportunities in what may well be the decisive decade of discovery on India for global investors. And the reason we are delighted to be hosting, together with Standard Chartered, an in-depth discussion on unlocking the opportunities that India presents to global investors and the role service providers play in this space. Now, in the next 60 minutes, we plan to cover the following topics: India's latest macroeconomic condition and outlook, India's capital markets and the areas that present interesting opportunities, including index inclusion. We will then examine in more details the latest developments in GIFT, India's smart city, and the country's first international financial services center. We will complete our conversation by looking at market access. How is market access improving? How can global investors access India and opportunities it offers? And now, to our audience that have tuned in to today's program, thank you very much for your interest. And we look forward to an interactive discussion. Send your questions throughout the session by typing them into Slido. You can see Slido on the right bottom of your desktop or device. We will direct this question as and when they become relevant to the discussion. Now, let's get going. It is our pleasure to welcome Anubhuti Saha, Head of India Economic Research at Standard Chartered. Hello, Anu. We are also delighted to have Chaitanya Joshi, also known as CJ. CJ heads up Financing and Security Services for India at Standard Chartered. Hi there, CJ.
Hi, everyone. Hi, Daniel.
Last but not least, Ashish Malik, Head of Financial Institution Sales for India at Standard Chartered. Thanks for joining us, Ashish.
Thank you. My pleasure.
Excellent. Now, let's get going. Let's begin with Anu, with the discussion on the macro picture. Anu, the ambition of India is to double the size of the economy before the end of the decade. Can you share with us what structural factors will underpin the positive growth into this future?
Sure, Daniel, and thanks for the question. I think the structural factors which are likely to double the size of the Indian economy before this decade ends. So it's expected to turn from a fifth largest economy to the third largest economy by end of the decade. It is purely a reflection of series of reforms which have been undertaken over the last decade. To start with, the list is pretty long, but let me flag a few of them. First is a significant push by the government to increase capital expenditure and improve infrastructure, which in turn has led to infrastructure-related efficiency boost. Just to quote some statistics, in comparison to all the 40 to 50 airports at the in 2014, now 65 airports in 2014. Now India has close to 145 airports. Roads built on a daily basis used to be 14 kilometers. per day. Now it is almost like 28 kilometers per day. So infrastructure capex has definitely helped improve the productivity, and that will underpin the positive medium-term outlook. Second is GST that has improved efficiency in terms of faster movement of goods. So a truck is able to travel 40% more of distance on a daily basis vis-a-vis what it used to do before pre-GST. Digitization is an extremely important part, which is clearly boosting both prospects for consumers as well as for businesses. Financial sector is extremely healthy. While there are few pockets of concern, the corporate leverage is the lowest since 2008. The NPAs at the banking NBFC sector is in absolutely low single digits, and the regulator remains extremely focused. Along with it, we have political stability and a lot of credibility for the central bank. The central bank has done a great job in ensuring external resilience. India has 12 months of import cover. Doubling of services exports has ensured that the sensitivity to oil prices is reduced. So these are whole host of factors which have boosted the medium-term outlook, for India, and will enable it to double in size by end of this decade.
Anu, thank you for that overview, and it's an interesting one. A lot of positive momentum that we're seeing. But when you look at these numbers, clearly you are very confident that the growth momentum will carry through the next coming years. Is that the case then?
Yeah, absolutely, Daniel. In fact, I would say that when we project India to become a $6.5 trillion economy by end of the decade, it's probably the one of the most conservative estimate. We are a nominal GDP growth of 10%, a real GDP growth of 6.5 to 7% will ensure India to double in size by end of the decade. If at all, there can be only an upside surprise. So yes, I would say that the conviction is extremely high when it comes to the positive growth momentum over the remainder of this particular decade.
And Anu, I see also some rating agencies have reflected that with their positive outlook that was announced in March as well. One area, of course, that we were observing as well, you touched on it, infrastructure and capital expenditure. It touches on things around fiscal deficit as well. I believe that it's slightly elevated than the previous years. What steps do you think are being taken to manage that without, of course, compromising government expenditure in support of growth?
Sure, Daniel. So I think what you mentioned is an important point about a rating, possibility of a rating upgrade. S&P has put India on a positive outlook for the first time since 2006. Last time India got upgraded was in 2007 to triple B negative. Since then, a lot has changed. And after such a long wait, they have put India on a positive outlook. And now, their two conditions are fiscal consolidation, that is, combined fiscal deficit lower than 7% of GDP, and durably low inflation.
That's right. Those are two key points. And this, of course, the fact that the levels are at the edge of where S&P is looking at. Are you seeing steps now being taken to address those issues? And on the inflation side, the core inflation itself, especially on food prices, have remained elevated as well. Are these areas of concern?
So on fiscal deficit, currently India is target. The combined fiscal deficit for this year is at around 7.6%. To move below 7%, in our view, that is highly possible because of host of factors. One, because of digitization and a lot of tax administrative changes, tax to GDP is improving, especially on direct taxes, which is a big positive. Secondly, the government is consistently working on rationalizing expenditure, especially in the unproductive sectors, which includes targeting the right beneficiaries rather than allowing leakage. The main thrust or the main push towards fiscal consolidation, in our view, is coming from revenue increase, and we expect this to continue going forward. The government has also promised that they will bring down, the central government will bring down its debt to GDP from 58% this year to 48%. The timeline is not defined, but given the fiscal prudence this government has demonstrated, our view is we will see it moving to 48% by before this term for the current government ends. So fiscal deficit is is elevated, but it has come a long way from the COVID period, and we expect it to consolidate further, primarily driven by government's commitment and tax buoyancy and cutting down of unproductive expenditures. Inflation, yes, the headline inflation is elevated. It is primarily driven by volatility in food prices. Core is very low. Currently, what we understand, obviously it's difficult to forecast weather, but food inflation this time India is likely to see a bumper crop. And if that plays out, then we will see food inflation coming lower over the next, a few quarters, like over 18 to 24 months, we can see food inflation contained. And we do expect, government is increasing its spend on agricultural sector. So all put together, I think there is a high probability that these conditions would be met, and that can at least keep the hopes of some positive news from the rating agencies over next year or couple of years.
Thank you, Anu. Just looking very quickly at the short-term aspect of it, we saw August goods trade deficit widen to 29.7 billion US dollars. Exports would decline by about 9%. How do you view it? Do you expect it to widen for the rest of the year in particular? And when you look at external demand, which is increasingly become important as India moves to connect to the global supply chain, what might it mean if there's a slowdown externally?
Sure. So on the recent widening in trade deficit, it is led by a couple of one-off factors. One, there was a gold import duty cut, and effectively it led to 8 to 9% reduction in gold prices. As all of us know, India is a big consumer of gold, and as a result, demand just increased. On top of it, India is now entering a busy festival and wedding season, so gold import can stay elevated. But we think we can get another higher or wider trade deficit print, but probably that would be story of just 1 or 2 months. Even the increase in non-oil, non-gold deficit is driven by the upcoming festival season. So maybe after $29 billion, we get another ugly print. But for remainder of the year, our sense is that the trade deficit should settle closer to $23-24 billion on an average, and that effectively, from a current account deficit perspective, indicates a very manageable level of close to 1% of GDP. So external sector remains extremely robust. There are a lot of capital flows, and we forecast that even if crude oil prices say move towards say $90, India's current total balance of payment surplus could be anywhere between $25 to $40 billion. So external sector is extremely robust. Trade deficit widening is just a one-off. How much can external demand slowdown impact India? It will obviously have an adverse impact. Primarily, we see a slowdown in US, which is the main trade partner. US is important both for India's exports of goods as well as services. But there can be some pressure, but all said and done, we still think that the current account deficit, even in the world, likely to be far away from the 1% of GDP number. And as I mentioned already, because of whole host of factors, yields coming off, index inclusion, etc., we think it will be easily fundable without creating any challenges for the rupee.
Yes, the capital flows is a topic we'll touch on next. And Anu, I just want to ask you very quickly on one last question on the external factors as it relates to the rate cut by the Federal Reserve of 50 basis points a week ago. and how are you seeing that sort of trickling down and affecting the macro for India?
The Fed rate cut clearly enables central banks across the region, especially in the emerging market space, to pursue an easier monetary policy. So it's definitely an enabler. For India, we expect the Monetary Policy Committee to deliver rate cuts, but it will be in a completely different proportion. India never raised rates the way Fed raised rates, and to that extent, the easing cycle will be far more shallower. The main driving factor for rate cuts in India, both in terms of quantum and timing, is the inflation trajectory. Currently, our view is that if weather doesn't play a truant, then we will see inflation coming off in the 4% handle. Average CPI is likely to be 4.5% this year, and that in turn can enable a total of 50 basis points of rate cut between December 24 and Feb 25. The balance of risk to this view is clearly of a deep, like another 50 basis points of rate cut. In case inflation remains well behaved next year, assuming good weather conditions and assuming we don't see a big increase in global commodity prices, especially if something changes when it comes to the China's story. So yes, monetary easing is expected, but much shallower. But risk is that we can see more rate cuts than what we are forecasting as of now.
Excellent. Thank you, Anu. Anu set us up nicely, CJ, to talk about the capital markets. India's capital markets enjoying a strong run. And I know you're very, very busy because of all the activity in the capital markets. The stock market is nearly up 15% for Sensex and over 20% for the Nifty 50 and touching all-time highs. Can you share with us the flows you are seeing from your clients, FPIs, also from mutual funds as well? What are you seeing?
Yeah, thanks a lot, Daniel. And you're right, we have been very busy, but it's a good kind of busy, right? So, key reforms by RBI and SEBI, the central bank and capital markets regulator, they have made the capital formation process easier with reforms of the primary issuances process, ease of doing business, new asset classes, efficiencies, and standardizations. As you mentioned, the capital markets are on a bull run with both the equity indices, Sensex and Nifty hitting all-time highs. In fact, India has crossed UK by market capitalization and has also surpassed China to become the top weight nation in the MSCI Emerging Market Index, the investment market index for the first time, with the Indian equities together carrying a weight of 22.2%, which is 27, which is just marginally ahead of China. And no, that was not for this call, but kind of mentions how timely this call is. And yes, we have been seeing a lot of increase in interest from both our foreign investor clients as well as our domestic investor clients. So this year, we have seen net inflows of over $30 billion from foreign portfolio investors or FPIs in 2024. The last quarter, starting July, has been the highest in the last several, with inflows of $18 billion in total, including over $10 billion in equities, possibly due to better prospects, number of initial public offerings or IPOs, and the increased weightage in global indices, including, apart from equities in the for the government bonds in the global market bond index. The sectors that we continue to see FPI inflows include financial services, healthcare, durables. Primary insurances have increased. Till the end of August 2024, approximately 50 Indian firms have raised more than $6 billion. And due to bond inclusion, 18 billion flows have also been observed.
Yeah.
I would just like to touch upon, the financialization of the Indian economy. So we have seen a trend of financialization of the Indian economy, where we've seen a movement from physical assets over the past few years, from such as real estate and gold, towards financial instruments. And within that, we have seen an increase in the capital market instruments such as equities and mutual funds. Now, the rise of retail and domestic institutional funds has complemented that of the foreign investors, with the investor base of mutual funds expected to cross 50 million unique investors. In terms of demat accounts, as per market reports, the dematerialized accounts from Jan 2023 to now, India added over 60 million new demat accounts. And today that stands at over 170 million as per the depository data as at end August. And this has increased almost 4 times since early 2020. Mutual funds have also seen a sharp growth in inflows, where their AUM has increased to overall to 690 billion. Systematic investment plans, or SIPs, which are like monthly investments, have tripled since the pre-COVID times to almost $3 billion per month currently. And this has resulted in greater participation of the Indian mass affluent segment into a mutual fund industry, and helps balance the impact of any potential dips in foreign flows. We have seen an increase in trend towards sectoral funds with a sectoral theme, for example, defense or infrastructure, depending on the theme at that time, with new fund offerings being around several different sectoral themes. And there have also been an increase in passive fund offerings from mutual funds, those tracking ETFs or index funds. However, in India, this still remains a single-digit percentage of the overall MFAUM. So we have seen a dramatic growth, but there's still a long way in terms of the actual percentage of mutual funds and demat accounts from the overall population, which just gives us a much larger runway ahead.
Yeah, in fact, CJ, that's a good point, right? I wonder, when we talk about India, we talk about the India's demographic dividend and the increase in savings that perhaps is driving a lot of this activity. Can you share with us how much of that sort of savings, how much of that demographic dividend that we talk about constantly is actually behind some of the numbers, exciting numbers that you've shared with us?
Yeah, absolutely, Daniel. So I think from that perspective, that is the financialization of the Indian economy that we are talking about, where we've seen, the mass affluent segment looking to participate in the equity industry, in the capital markets through financial instruments. Taxation changes have also helped. And you have seen, an increase in the youth population looking to diversify from physical assets such as gold and physical instruments to monetized instruments. And that's where, the quadrupling of dematerialized accounts where you would hold these financial instruments have come in, over the last 3 to 4 years.
And CJ, is it via some of the digital channels and so on? We talk about India digitization. Are you seeing that this young people or the investors, younger investors, actually using more digital type channels to access the capital markets?
No, certainly. So I think we have seen a rise in zero fee brokers, people who have launched app-based facilities for and made it very easy for the youth to invest into the markets. we've seen SEBI takes a lot of steps to digitalize, the KYC process that mutual funds and brokers have to do, and hence reduce the cost of onboarding of a new investor and therefore make it more participative. We've even talked about, the capital market regulator also reducing, the amount of, a mutual fund investment to say a minimum of 250 rupees or cheaper than what you would get a cup of coffee in a large multinational chain, right? So that's where they're trying to increase the digitization and the reach. A lot of the reach and growth has actually come from outside the top 8 cities, if you go by, press reports, and that's fueling, a more widespread nationalized approach into movement into the capital markets.
Excellent, CJ. Let me bring Ashish in on the topic you touched on, Anu and CJ earlier on. We talked about bond inclusion, right? Of course, this is a big story that we saw with the inclusion starting in June, end of June this year with JP Morgan emerging market bond index. Ashish, maybe you could share with us what are you seeing? Can you share with us what have you seen so far? Everyone talks about $20 billion US dollars or $30 billion US dollars. Where are we in that kind of accounting?
No, sure. So I think probably similar time just last year in 2023 September, we all woke up to this idea that India being added into the JP Morgan index, and come June we will have flows coming in. So Standard Chartered, as one of the largest primary dealers, are seeing a lot of interest both on the custody side to open accounts, as well as on the trading floor, where we do see newer clients and funds being onboarded and significant amount of flows being routed. I think CJ has already mentioned the number of $18 billion or so. But from a more market participant perspective, this is very significant. One, adding into the index gets India as a country a new set of investors that never invested in. For the investors, it gives acceptance to the bond market much more than what it was before, given now it's part of the index. From a foreign investor perspective, you probably get the highest yield in the region with probably the most stable currency. So it is one of the highest yielding countries in the region that are part of the index. From a domestic investor perspective, you get another new set of investors that helps increase the liquidity in the market and the depth in the market. So overall, a super positive news for India, whatever the numbers are, 18 billion or so, and likely to probably add a couple of $1 billion every month for the next few months. So very, very positive for all stakeholders. So I'll pause.
Yeah, Ashish, just for the benefit of our listeners on this webcast, which Indian bonds are now eligible or a part of that index inclusion that people should be looking out for? What types of bonds are we talking about here?
Yeah, so these are across the curve. The Indian bond market is about 1.1 trillion US and quotes up to 50-year in duration. There are series of FAR bonds, the fully accessible route. There is a weight that is published for each security, and the duration is out up to 30 years, I think, for these FAR bonds. So if these are the bonds which are part of the index. The end investor may or may not really go in that duration, in that weightage. They may have a different weights as opposed to what is prescribed by the index, but these are across 30 years. And the government bond market in India is out to 50 years.
Yeah, so quite a lot of choices for investors to look at. And I'm sure with the work that you've been doing, you've been getting a lot of queries from your clients regarding access to India. And speaking of access, of course, India and the regulators have been doing quite a lot in terms of improving that. And one area that have stood out in particular, has been the Gift City, right? Can you give us a little bit of an update on the Gift City? I know that it was set up sometime, 8-9 years ago. Has it become a gift for India, becoming the global gateway for accessing India and facilitating also foreign investing as well?
No, absolutely. I think this is a favorite project right from the government level. And the way I would put it is the idea is to create Gift City as a global gateway, a global gateway to India, and to create and to put in processes, policies, infrastructure for a foreign investor to think of Gift City as an alternative to maybe a Singapore, maybe a Mauritius, maybe any other offshore Dubai, maybe any other offshore jurisdiction where they would set up a pooling vehicle and then access India. So the idea is to give competition to those well-developed financial centers offshore within the territorial jurisdiction of India. And the government is very, very keen to understand on what are the things that can be done, what are the things that investor needs. So a couple of things they've done is around relaxing the product suite. So today in India, if a client wants to do a credit derivative, apart from a CDS, there are very limited products that can be done. But in Gift City, the whole suite of credit derivatives are permitted. The idea around from a taxation perspective, they have built-in policies that would incentivize offshore pooling vehicles to set up in Gift. So the idea from the government perspective is not just, of course, it is to get the foreign investors to enter India, but the idea is the overall development, whether it is boosting infrastructure, whether it is, sustainable urban development, whether it's employment generation. The idea is completely encompassing for Gift City, and I see it panning out very, very well with I think more than 20 banks, more than 100 institutions being set up in Gift already.
Yeah, indeed. And CJ or Ashish, of course, Standard Chartered was one of the first ones over at Gift City. I wonder, sort of having since launched the operation in Gift City, the branch in Gift City, what have you been able to undertake during this period?
We are probably the first foreign bank branch in Gift City to have applied for and got an FPI license. The idea for us is very similar to be aligned with what the government plans, is to use Gift City as an access route to India. So if you are a foreigner looking to buy onshore bonds, onshore equities, onshore credit, and doesn't want to go to the rigmarole of the FPI process or needs access and leverage, the idea is to start issuing P notes and ODIs out of Gift City. That is something that Standard Chartered has taken lead on. Apart from other things that I spoke about, including commodity hedging, including credit derivatives, is something that we all are exploring, and we've even done our first trade out of Gift City around commodity hedging. But that aside, the idea is to use it as an access route into India. So I'll pause. CJ, over to you.
Thanks. I lost you for a second, so I'm not sure whether it came across, but we were the first foreign bank to set up in the IFSC Gift City, and have constantly expanded our range of services there. So the IFSC actually gives several. There have been several regulation and tax changes, trying to promote that as an international financial center, including 100% tax exemption for 10 out of a 15-year block period. In addition, there are no goods or services tax or securities transaction tax on transactions made on the IFSC exchanges. And this has led to fact that interest income earned there, they do see tax benefits. So we have seen some of our clients and funds looking to set up fund vehicles in the IFSC Gift City, and we have several clients who have registered their FPIs from into India from vehicles set up in Gift City as a pooling vehicle, and then invest into India. We have also have pioneering examples of Gift City set up funds investing outside India into various global jurisdictions through our regional custody hubs.
And CJ, just a quick follow-up. In terms of using Gift City, when FPI clients come to you and they ask questions around it, between organizing themselves via Gift City or just generally entering India via the normal FPI route, what sort of advice are you giving them, and the pros and cons that they should be looking at, and advantage and disadvantages?
Yeah, that's a very good question, Daniel. I think it depends on each client structure and their strategy, and therefore, if they are looking to have like a pooling vehicle in Asia, then possibly Gift City would make sense for them as an alternative jurisdiction investment. It depends on their strategy, their structure, and the taxation benefits that they get versus their home country jurisdiction, and whether, of course, whether they have a long-term view on India. We have also seen clients potentially looking at it to as an investment, not just for India investment, but for as a hub for alternative hub for global investment as well.
Yeah, indeed, CJ. Thank you very much. One question that I often hear, because of the ambition of Gift City, is creating enough of a talent pool within Gift City. Are we seeing the beginnings of that in terms of drawing world-class talent to Gift? Ashish or CJ?
Absolutely, and I think GIFT's the Gujarat state has been has some of the finest management schools and universities in the country. We have, with the social infrastructure increasing, the government is working on that feedback and have taken steps to better the infrastructure, and we have seen as the economic opportunities increase, more and more people looking to have senior professionals based there. In fact, Ashish has also seen that with being able to hire people in IFSC Gift, and we are now as a bank looking to expand our staff there as well.
Excellent. Ashish, just one more question on Gift City, right? When you talk to investors who are planning to come in via that channel, what are you hearing from them in terms of what they hope to see in terms of new regulation or new products or new financial offerings that may be available in the coming months?
So there are multiple things that investors would want. So if you are a credit investor looking to buy high yield bonds into India, so the question is more whether should I set up a vehicle in Gift versus their home jurisdiction that CJ spoke about, versus should they be setting up AIF in India and using that as an investment vehicle. That's when they're setting up the vehicle. The next question is when they want to access the trade. The question is, should they be buying a TRS product if they're not setting up as an FPI from a Gift institution versus an offshore institution? There will obviously be pricing and taxation aspects that CJ spoke about, but that will be their thought process. What is something that they really want you to do? So there are a couple of things that we're working with the regulator. One of them being maybe giving leverage on back of AIF units. So if I, as an investor, have set up an AIF in India, my AIF makes an investment into a corporate bond into India, and my AIF issues a unit. Now, what we want is Standard Chartered to be able to buy those units and give leverage to the end investor. But that's something that we're working on. So I'm sure there are a lot of other things that different investors have different one that keep coming across commodities, across FX and rates. So like there are in Gift City, there are certain currencies that are not permitted. So there are certain investors who would want those currencies to be developed. So that is something that is in discussion with the regulators. The good thing about Gift City is we have a unified regulator in the name of IFSCA. So the IFSCA kind of combines everything that multiple regulators in India do differently. It's only one. So things are a lot easier.
Yeah, of course, Gift City is competing with the other financial centers. The closest that I can think of was my recent visit to Dubai. And CJ, how far away, how close do you see gifts in terms of relative to places like Dubai, not to mention, of course, Singapore?
Yeah, so I think, Daniel, that is again goes back to clients' philosophy on their strategy, the structure, and their tax benefits. And if they have a long-term view towards India and are looking to, that's where we see GIFT FSC as an opportunity. The DIF regulators are also quite receptive and forward-looking to feedback. And there is, we have seen a lot of increased activity in GIFT in the last 2 or 3 years post-COVID. And now we are pretty positive that this growth will continue, both in terms of capacity as well as growth in infrastructure and products, right? And therefore, different IFFCs have to kind of form their own niche and will have their own, value depending on the client set and the gateway of the region they are to.
Excellent, CJ. I could see a number of questions from the audience now, and thank you very much. We will get to those questions. Many of them, I think, related to Anu's earlier opening on macroeconomics, but we'll get to it. But right now, because of the interest among the listeners about access to India in particular, I saw some of a lot of them, I think, are quite new in terms of looking at India, but clearly interested. CJ, when you look at India in attracting interest, we're seeing that happening right now, as the numbers you've shared with us. But can you share with us a little bit how access has been simplified, especially for FPIs, and what has been done of late that is particularly notable for potential investors looking to come into India?
Sure. So, Daniel, I think, we have more than 11,500 FPIs registered in the Indian market. And the capital markets regulator follows a very conservative process in relation to attracting interest from foreign investors. They have formed an FPI cell to seek feedback and improve the market access. We've seen over 600 new FPI registrations in 2024. Primarily, the FPIs come from United States with 30% of the registrations, Luxembourg and Canada, and then other centers such as Singapore, right? The SEBI and RBI have taken several positive and welcome steps, to simplify access, reduce risk, increase market transparency, and settlement efficiency in a very vibrant and evolving landscape. So few of the changes is, of course, to ease the entry norms. So they had a single common application form, or CAF, for getting started across the FPI registration, income tax application, and the depository account opening all in one place. There have been a common standard operating procedures to put uniformity in documentation largely between various market participants and the registration process. FPI registration can be given, on the basis of scanned documents. Digital signatures can be accepted, subject to them being, through India certified authorities. And they've done various other, smaller changes, of uses of various mechanisms and ease in the certification kind of process. From a ease of compliance, they have typically look at making major changes in policy through consultative papers and having a consultative approach. Have an industry standard forum, which we are a part of, for setting some of these common changes. They are material changes on what changes you need to report to SEBI and your FPI registration, and where various working groups to harmonize the the experience and the disclosures by FPI. From ease of trading and investments, they've looked at a faster settlement of trades. India was first to move to the T+1. They're envisaging a common contract note across the two exchanges, multiple exchanges in India. FPIs have been allowed to invest in ETCDs, alternative investment funds, as well as REITs and NVITs. The timelines of capital market issuances have also, or IPOs, have been reduced significantly from 3 days to 3 days to closure of the issue to listing, as compared to 15 days a few years back.
And CJ, clearly the regulators are looking at making it easier for the access and simplifying, and also accelerating that, including things like the shortening the settlement cycle. A lot of the conversation around the move to T+1 recently, and service providers like yourself have to keep up with some of these changes. How have you managed to do so? Or has it been complicated in terms of keeping up with what regulators want? And the next stage, of course, they're talking about same-day settlement, right? T+C. Are you ready as well?
Yeah, can you hear me okay?
Yeah. Yeah.
Yes. So I think from the T+0 option, it's an optional cycle in to reduce the settlement cycle. It went live in a beta phase from March 24 for a limited 25 securities for the retail investors. From September 30th, we expect that the optional settlement cycle will also go live for institutional investors. And this is a major market development where the regulators have envisaged to reduce the market risk, post successfully implementing the T+1 cycle, and looking to drive innovation in the market, for stable models. We have been part of the working group along with the exchanges, depositories, and clearing corporations to provide enablers for this accelerated cycle. So we expect, while broadly the model is known, we expect the final circulars to be issued shortly, and that to then go live from next month for institutional investors. But again, this remains a totally optional addition to the current T+1 investor cycle.
Are you seeing, CJ, are you seeing what sort of level of interest are you seeing from your clients, from your investors, to move from T+1 to same day settlement?
Yeah, so I think it is definitely, I think, a case of as of now, because it's been only beta rollout to the retail investors. We are seeing inquiries from the T0 cycle in terms of the settlement process, in terms of the timelines, etc. And once the cycle actually go live, that's where we really see, what the interest is from our offshore investors, as well as other domestic institutional investors who we have been engaging with. But again, since it's an optional cycle, we'll just have to wait and see how the liquidity and the interest develops, Daniel, in this cycle.
Excellent, CJ. We've got about 10 minutes left for this session, and just the questions that are streaming through from the audience, I'd like to pick up a few of them, actually. Question for Anu, actually. Where is the crop bumper coming from, considering that crops are being impacted by prolonged monsoons?
Yeah, so you're very right, because monsoons are, till now monsoons have been pretty okay. There is a skewness, but if we look at the main crops of the summer season, which are rice, certain varieties of pulses, and these particular crops have very high weightage in the CPI basket. The area sown is higher than last year, and the rainfall skewness is lesser in the what we get to hear is that the crop damage has been very limited, but of course we'll have to await another couple of weeks to get. Hi,
I know we miss you on the last bits. Maybe if you don't mind just repeating the last bits of what you were saying.
Yeah, so a good crop is expected primarily because area sown is higher than last year. Secondly, last year was an El Nino year. This year there is monsoon is excess in certain parts, but the main crops, the skewness is not that bad. And till now we have got news that the crop is not as badly is not damaged to that extent. But we'll have to keep a close eye on the weather pattern, especially rains, for next 2 to 3 weeks to get a much clearer picture on how large the crop would be vis-a-vis last year.
All right, excellent, Anu. Here's a question. I think this question, CJ, is for you. Are there any developments on the tax incentives for foreign investors? For example, short-term versus long-term investment capital gain tax charge, which, according to this listener, so far not very conducive.
So of course, there are several proposals that have been made, and the financial ministry always do consider them. I think the right channel for that is through the various tax advisors that the clients have, to forward that, to the finance ministry and engage. But there are constant efforts being made to make it more conducive to foreign investors. But I think the tax firms would be the right ones to engage with the government on it, and they are looking at tax structure simplifications as well.
Yes, indeed. Thank you, CJ. Thank you very much. Ashish, I think this is a question for you. Do you think the government will consider allowing full accessible route FAR bonds available through the Gift City setup?
Buying the fully accessible route bonds entails that you still have to apply for an FPI license. If you are a non-resident and doesn't have an FPI license, you still have to apply one if you want to actually buy the bonds physically, in the sense, not in a derivative format. SCB Gift City or Gift City can be a counterparty to buy and sell bonds, even in today's context. So if a client wants to trade with Standard Chartered Gift City, Standard Chartered Gift City can buy the bonds on their behalf and sell it to the FPI. But the end investor needs to have an FPI license.
Okay, thank you. Thank you very much for that response. CJ, there's a question about settlement cycle, right? Now that same-day settlement is in sight, right? How far away do you think would atomic settlement be? How difficult would that be? And is that being considered right now by India?
Yes, that is being considered. There are plans around it. There are proposals around it. But on atomic settlement, as we would say, it would be a completely different kind of approach, to the T0, T+1, model, which is actually an extension of the model already in place, albeit with, certain timelines, shortening, and certain tweaks. So the atomic model would be looked at potentially, after the T0, kind of kicks out and settles in. And there are consultative processes, where there is a consultation paper and market feedback would be taken, and then that approach, would look to be rolled out. But it would be at the beneficial owner segregated market structure level, and therefore it would look to happen there. So that there is a broad thought on how this model would be. But the sense that we are getting is that first T0 would be rolled out, and then post that, this would be considered, next year.
Thank you, CJ. A few more questions, and thank you very much for your excellent replies. Anu, there is some comment from listeners that there may be a skills shortage in India. India's export of high-quality manpower engineers at loggerheads with the goals of Make in India. There's a related question around female participation in the labor force. How do you view this as sort of areas perhaps the government should be looking at in terms of improving, do you think? Or in what other areas should the government be addressing in order to continue to maintain the growth level?
Sure, Daniel. So I think when we talked about our positivity about the growth outlook in the remainder of this decade, that clearly is dependent on the structural reforms made in the last decade. If the same level of growth momentum has to be maintained in the next decade too, probably we will need more reforms. One would be obviously and that's something where the government is working, is to ease the whole process of doing business in India. It is relatively easier to do business in India vis-a-vis what it was a decade back. It is on a global basis, India still remains a slightly more challenging place to do business. And the government is working to ease that. So this is an area where government is working, and we would like to see a lot more action on that front. Second, yes, very right observation. Skill development still is an issue. Similarly, I think for the manufacturing sector, what basic reforms, important reforms around ease of acquiring a piece of parcel of land or hiring and firing of the labor, etc., is something where we need a lot more clarity. And one of the top officials of the government is talking about creating special focused areas where these can be done much more easily. Skill development is an area which the government has started taking steps. So in the budget, they announced a plan where public-private partnership. So the funding would be done by the government, the training would be done by the private sector. So it's a good step, but a lot more needs to be done. The other part where we hope to see more action is hopefully on the climate change. India's agricultural sector contributes only 15%, but more than 40% of the labor force is still dependent on agricultural sector, and climate change is a reality. Again, the government has started taking steps, but still this is a long way for more to happen. So I think it's a broad-based set of issues. I think developing the software infrastructure on skill, education, health, climate change, which is extremely important, is the whole process of doing business. And I think if these are the areas where we get more action in the remainder of this decade, the next decade can look equally bright for the country.
Thank you, Anu, and thank you all for sharing so much insights. I think a lot of our listeners are particularly interested in many of the comments you've made, which is very helpful as well. We've kind of run out of time. There are probably a few more questions, but we probably have to end here. And I want to thank our panelists here who joined us. India, of course, and investing in India is without question the most exciting story for all of us, local and global investors, particularly. Our discussion brought to the fore why that is so, with Anu sharing what she sees are the drivers of India's story today and to the coming years as well. We also heard from CJ the considerable funds flow that's pouring into India's capital markets across a wide spectrum of interests, whether it's related to infrastructure, digitization, and so on, healthcare. We also heard from Ashish how the gift city is starting to become an investment magnet, and what the government and the unified regulator in gift city are doing to further boost the city's attraction. And finally, we learned how access to investing in India is being streamlined further as interest from global investors continue to grow by the day, and how regulators in India, such as SEBI, RBI, certainly focus on making access to India, including shortening settlement cycles, as part of that drive for greater efficiency. And we want to thank you for joining us today on The Rise, Unlocking India's Opportunities. We hope that you found the discussion helpful. Let me now thank our speakers, Anu Sahai, Head of India Economic Research, Standard Chartered. Thank you, Anu, for your comments.
Thank you.
We want to thank CJ, Head of Financing and Security Services for India at Standard Chartered. Thank you, CJ, and we look forward to more interactions in the future.
Thanks a lot, Daniel.
And last but not least, thank you to Ashish Malik, Head of Financial Institution Sales for India at Standard Chartered.
My pleasure. Thank you so much.
Excellent. To our viewers, please let us know your feedback for today's session, and we look forward to welcoming you to the next The Asset Events Plus exclusive webinars. In the meantime, please stay safe. Bye for now.